Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Bryonick, and this week I'm joined by Maddie Johnson. She's an associate stock strategist here at Zach's, and she's also the editor of the Dividend Investor, which is one of our Zach's weekly newsletters here. And that's vital because I'm having her on to talk about how we can buy innovative stocks, companies that, are innovating in things, but the ones that will also pay you some cash, just cold hard cash right into your account. We all like that, right? So, Maddie, I wanted to have you on because I feel like dividends, for some reason, are kind of hot right now. Like everybody wants some. And I think people have this idea of them that's a little bit old, maybe some of the older investors only have this idea that it's only these kind of old stodgy companies that are paying the dividends. But you can get dividends through some of these kind of hot, innovative companies now.
Yeah, for a long time. I mean, not for a long time. I just feel like forever. When you think dividend stocks, you think utilities, you think consumer staples, you think insurance companies, you think telecoms.
Yeah.
Which aren't, no offense to any of those companies. They just aren't very exciting.
Right. No offense. Let's call them the boring stocks.
Yeah. But, they have offered shareholders something really unique is that they're stable. They stable growth, stable revenue, stable earnings, and that results in a stable dividend.
Yeah. Now, what exactly is a dividend? Like, why do I want to get it? Why do some companies pay it and other ones don't? Like, what's the whole deal with the dividends?
So a dividend is it's a quarterly cash payout, and it's exactly what you said earlier. I mean, it's just like cash in your account as a reward for investing in a certain stock in a certain company. And it's usually, so why we think of old stodgy companies as the only ones paying out dividends, it's because when a company is able to give their shareholders that little reward, it's because they've entered a point, it's like they've entered like a stagnation era in growth where they're not really churning out like high growth earnings reports, high growth numbers, high growth research and development. So like that money that they would put into like R&D is now going into the pockets of shareholders, which is great. Yeah. So if you look at Microsoft, they started paying a dividend in 2004, and they're a good example of a tech company that does actually pay a dividend. But 2004 was when like Microsoft just wasn't the high flying stock it is today. They didn't. The company didn't see the need to reinvest its earnings to fuel high growth. So now they pay a dividend. They currently yield, their shares currently yield like a tick under 1%. But that's because Microsoft stock has just soared into the stratosphere over the last year. So their yield has really come down because of that. But yeah, so Microsoft is a good example of how or why companies start paying dividends.
Yeah, I used to think of dividends with some of these big cap companies as a way to reward you for like sticking around. Like when things are going so great, at least getting this dividend. That's kind of what was happening in 2004 when Microsoft started paying that dividend out.
Yeah.
Is that, the shares had really declined in the .com bust, basically, and they needed to do something. And they had great cash flow, which they still have. And so they were able to start that and kind of, keep shareholders at least happy for getting something for sticking
Exactly.
around.
Yeah. And another example of that is IBM. They currently yield 5.2%. But as we know, the past decade or so has not been great for the company. It's just been super stagnant. They just haven't been able to find those key growth catalysts. But as a reward for the shareholders who have stuck with them through kind of like lots of different obstacles and turmoil, I mean, a 5.2% yield is pretty great.
Right. But what about that old saying, like, when you get those higher yields, like anything 5% or higher, that you should be cautious because something else could be going on at the company? Like, why am I getting this if things are good? Kind of.
Yeah, that's definitely like those high yield traps, kind of like a value trap. Like, it looks really good on the outside, but once you start digging into, you really have to take time to look at a company's balance sheet. So, right, with anything you're investing in, like looking at a balance sheet is key, but with dividend stocks especially, you want to make sure that the payout ratio is good. 60%. So if a company pays out 60% or less of their earnings, that's kind of like a good way to gauge if the dividend will be safe, or and to see if a company isn't paying too much of its earnings in a dividend. And you want to look at cash flow, right? Like, does a company have enough cash flow, free cash flow? Are they growing their cash flow to actually sustain the dividend as well?
Okay. So where do the energy companies come into play here? Like specifically like Chevron and Exxon, they're not necessarily the innovators, although maybe some people might consider them to be innovators going forward here with a lot of changes that they're going to be doing to their companies about the climate issues and all of that. But those were well over 5% in 2020 with the pandemic, collapse of oil and all of that. And they've come down, but they're still really high. And there was a lot of questions about whether or not those companies would continue to pay them because they didn't have the cash flow to cover. But both Exxon and Chevron have continued to pay it and have said that they are going to. But should investors be cautious in anything like on the commodity side, like in energy?
Oh, I think so. So I added Chevron to income 2 weeks ago now, right at the end of February. And I was really unsure because I had a few oil and energy plays in income up until the beginning of last year when oil prices tanked. Yeah. They went negative, and I just had to cut my losses because it was really sad just looking at the portfolio. But I just felt it was time to get back in with crude, on the rise again. And I liked Chevron because its balance sheet is really stable. They just have a ton of cash. So, but even with that in mind, and even with their juicy dividend, that's always going to be on the back of my mind with any type of commodity play, because you just don't know. I don't think maybe oil experts did last year, but I don't think retail investors or us, we expected oil prices to go negative. It just felt kind of crazy and scary. And, but that can happen, I feel like, with any type of commodity too.
Yeah, for sure. Okay, so let's talk a little bit about the innovators. Now, to prepare for this show, I kind of looked around going, of course, I could find all these innovators that pay good dividends. I thought above 1% maybe is what I consider to be good for like a more dynamic company to be paying it out. And I was like, oh, there's got to be dozens of these. But then I discovered, whoops, there really aren't. There's not that many. I looked around like in the medical area because there's all those companies innovating in medical products, drugs, the biotechs, all of that. And I thought certainly what about Edwards Life Sciences or Intuitive Surgical? They're huge. They got to be paying a dividend. But no, they don't pay anything, let alone like above 1%. So I did find that it was more difficult to find ones that are kind of more companies on the cutting edge when I was
yeah, so I'm going to jump in really quick. So when I look for stocks for income, one of my key things is if they have a yield that's greater than the S&P 500 at the moment. Okay. So the S&P yield's about 1.5%. Obviously, it was higher at the end of 2020, and it's come down quite a bit. So I just like to make the case that if you invest in a certain company, that it would be more rewarding for you as a shareholder versus if you were just to put your money into an S&P fund ETF something like that tracks the S&P. So that's what I look for. I mean, 1%, that's still a really good yield.
Yes.
But I like looking at or comparing it to the S&Ps.
Well, and the 1%, or if you get like 0.5, I know it can get kind of depressing because you're like, oh, I got my dividend. Wait, it was literally like $4.
Right.
And you're like, oh, it's going to take me a while to get to that one share bonus in there.
Right.
So that's all kind of lame. So when I'm looking for dividend stocks just for my own personal portfolio too, I do like to get the ones that pay more. So that makes sense that I might as well get more than the S&P 500 because I can just go buy that index and get it.
Right.
Exactly. So I might as well get more. And it's more interesting because I get the cash in the account and it's fun that way if it's bigger.
Yeah.
So, yeah. Okay. So do you want to start with like an innovator and then I'll do one after you do one and then we'll kind of see what.
Well, yeah. So when I was also looking for stocks, I don't even know if they're very innovative either, but the one that stuck out to me was ABBV, ticker ABBV.
Yeah.
They were spun off from Abbott Laboratories a while ago, but they're a really cool pharma giant, pharma stock. I believe they have Humira. That's like one of like their leading drugs, but they also specialize in genomics and cancer research. But what stuck out to me was their yield, 4.9% dividend yield right now. They also boast 47 consecutive years of dividend growth. So that makes them a dividend aristocrat, which are companies that have increased their payouts consecutively for 25 years or more. So that's a really big draw. Their payout ratio, according to our data, is 49.5%. So that's pretty comfortable. So I don't think investors would have to worry about AbbVie overextending their earnings, so to speak. And then I also saw that Warren Buffett and Cathie Wood just bought AbbVie. Buffett, I'm for Berkshire Hathaway, and I believe Cathie Wood for her ARK fund, but I could be mistaken on that. And they also only trade, they're really cheap. They've been really cheap for a long time, which kind of makes, it's like 8.5 times forward earnings multiple.
Yeah.
So, I mean, I don't know if that makes it because they've been trading so cheaply for a long time. If it, should be concerned if it's a little bit of a value trap, but I don't know. From what I just like these very basic bullet points that I've jotted down, AbbVie just looks like a really, it could be a good pick for an investor who wants a dividend stock, but also wants exposure to medical and pharmaceuticals.
Yeah. I agree. I just bought it for my own personal portfolio. A week ago. Yeah. So I'm a new investor. And Buffett did get in at the end of 2020, and not surprising because it is so cheap, as you mentioned, even on a PE basis and all of that, and its financials are so solid. But I'm hoping Cathie Wood bought it for the one thing that they did buy, which they closed on this deal not too long ago. I think it was last year, which is when they bought Allergan and got the Botox.
Right.
So Botox now. But one of the issues with them is that big drug Humira is going off of its patent protection in 2023. Yeah. So for the last couple of years, everybody on the Wall Street has been freaking out because it's a huge percentage of their revenue. This was before they bought Allergan. And everyone was wondering, how do they keep going? What else do they have in the pipeline? They don't have anything that can replace this, and revenue is going to fall. But they're not dumb. They've been working on replacing it, which is part of the reason they bought Allergan. And they are saying that they are prepared for it to go off the patent, the protection in 2023, and that the dividend is fine and they intend to grow the dividend and the rest of the business. So to me, it looks like they're going in the right direction, and the street will ultimately realize that, but they may not realize it until it actually goes off, and then we see. So that's still another 2 years away. But yeah, like they are rewarding the shareholders for sticking around, and you do have to like that yield for sure.
Oh, absolutely. Yeah.
So real cash in there. Okay. I do like that one. And evidently I'm realizing I must like dividend paying stocks, because the other one I do like is the one in the cannabis area, which most people don't know about because it is a REIT, which is a little bit, but Innovative Industrial Properties is its name. I've talked about it many times on various podcasts. IIPR is the ticker. So what REITs do, for those who don't know, it's a real estate investment trust. So the tax implications are a little bit different. So be cautious on the tax part, because those kind of companies pay out 90% of their taxable income to shareholders. That's why you get big dividends with REITs. And they're usually like hotels or, you know, any kind of property, farmland. There's a REIT for farmland. But this one is on cannabis, and IIPR buys up buildings and structures, and then the growers lease back from them, and at very high rates, because the growers cannot yet go to banks and get money to expand their businesses. So IIPR basically acts kind of like a bank for the cannabis industry in the United States only. And every state that passes either medical or then for the leisure type of thing, IIPR usually ends up going into those states and buying up various properties and then working with the growers in those states. So they've been doing it for 5 years now, I think they have. And so they're the leader in the industry of basically providing capital to the cannabis industry. Now they lease it back out at rates that are like super high, 11% to 15% on long-term leases, which used to be 15 years, but now the company is saying a lot of the recent ones have been 20-year leases at anywhere between 11 and 15%. So you could see that they're creating quite a lucrative business for those who are shareholders.
Right.
So this one used to yield more, but then the shares have soared. They are up 77% in the last year, but they have pulled back in this growth stock sell-off that we're having here in 2021, and they're down 20% off the last month. So you're getting them a little cheaper here, and now it's yielding 3% to shareholders. But they have been raising the dividend because they're going into new states. They're getting, more income is coming in each quarter. And so they have been raising it just about every quarter recently. They've been adding onto it. So IIPR is a way to legally get into the cannabis area. One area of caution. Now, I own IIPR also in my own portfolio because I did love the dividend and the idea of owning a cannabis company that actually has great cash flow and that, is at the top of the industry.
I also own it in my personal portfolio as well.
Yeah,
for most of the same, almost all of the same reasons you just listed.
Yeah. It's a cool company to own, I feel. But the one danger, and maybe some of the reason for the recent sell-off as well, is that if or when they do some kind of federal legislation on cannabis that either allows banking to happen or actually decriminalizes the industry or whatever changes they may make to the legalization of cannabis at the federal level, means that once you get banks and other financial companies able to lend in it, there's going to be a lot of competition for IIP. Right. They're no longer going to be the sole or among the sole options for a lot of the growers. If the grower can go to the bank in its town instead of IIPR and pay less to get the cash, they will, obviously. So that's one of the dangers that's kind of lurking out there. But IIPR, right now is in the sweet spot because it is locking in the 15 to 20-year leases on the current deals it's doing. So this is something to keep in mind. It's not, It's not free and clear, and it all depends on when some of this legislation might go through. Now, they have said on their recent conference call that they feel like they're competitive in the capital markets for what they're providing. And a lot of the big growers now, some of them are, seeking and need cash of like 200, 300 million in addition to the property locations. They need even more cash. They are able, some of the big growers, able to tap the various capital markets or to do SPACs even and tap it that way. But they do have to give up an ownership portion when they tap that way versus just entering into a lease with IIPR to tap some cash. But they are, some of the big guys are able to find other sources even right now. But there's still, it's such a growing industry. There's so many, even of the mid-size growers that do not have the capabilities that the big guys have. So they still have plenty of customers, future tenants that are out there. But you will have to watch the quality of who they're leasing to going forward and how that's going to work too, if they start to go from some of the biggest players down, some. But we just had elections where several more states just allowed medical marijuana and recreational again, I think. So they're going to be entering into those new markets, and they're still going to have, quite an advantage because they now have 4 to 5 years of experience lending to this industry, basically, or entering into partnerships, which is really what it is. So yeah, I like innovative, but it does have this slight tinge of danger lurking there.
Yeah.
And it's not like their business is going to go away completely. They're just going to get more competition, and it could evolve into more of a standard REIT. You're not going to be up 77% in 1 year going forward, possibly. So that's
And I feel like this the lurking danger that you wonderfully explained is something that we as investors and just like us stock analysts just watching, it was always there on the horizon. Like it's like over like the past few years, as more and more states legalize recreational medical marijuana, that was always kind of inevitable that innovative would one day experience like just more competition as it is in any industry. But I think you're right. I think that they're going to be the number one player to beat in the grow house space for a while now.
Yeah, for sure. Okay.
Okay. So I also found a REIT that I liked. I don't think very innovative, but it's it's Weyerhaeuser, WY. It's the timber, like the biggest like global owners of timberland.
Okay.
And I didn't know they were a REIT. I just thought they were like essentially like a lumber company, but they own 25 million acres of timberland in the US and Canada.
Okay.
So they manufacture wood products, structural timber, engineered wood, and other types of things. And markets are like residential, light commercial, and industrial. But I wanted to highlight them because of their connection and how they present a good read of the housing market.
Oh, okay.
I'm sorry.
What is it?
So
what do they
So
yield?
the yield is 2%. They have a payout ratio of 52.7%. So that's still nicely under that 60% threshold that we like to look at. They trade about 18.8 times their forward earnings multiple. But management is still, so from their most recent earnings report, management is still pretty rosy on their outlook going forward, even with like the housing market looking as hot as it has recently, basically the entire year. So with them, they really take into account housing starts and housing building and new house building and stuff like that. And this whole wave of millennials and new home buyers moving from cities to the suburbs, looking for houses to just have more yard space, whatever. That's really been beneficial for the company last year. And in the management and the top guys, they don't really see that ending anytime soon. Okay. So if you're looking for a way to kind of invest in the housing market, choosing WY for your portfolio is like a different way to kind of get in there. And I was also seeing that the company is going to pay an earnings-based special dividend in the beginning of next year, so 2022, and that will help boost that 2% yield even further.
Yeah. Okay, that's an interesting one. Okay, so I have one too it is commodity based, but I feel it's very innovative based not on the commodities. So my stock is Nutrien, ticker NTR, and they are on the fertilizer side. They're headquartered in Canada, and they were formed when they merged with the Potash, however you pronounce it, Potash, and Agrium merged to create Nutrien. And so they have that side. They have the fertilizer side, which is actually getting really hot right now. Prices are higher for both potash and nitrogen, and the sales are higher. Farmers are doing better. The weather has cooperated with the farmers for the spring planting, all of that. But that's not why they're innovative. I feel they're innovative because they've launched this whole digital retail channel. So they own a lot of retailers that sell seeds and other things for the farmers. That was another segment of their business. And now they've renamed it to Retail Ag Solutions because it now has this digital platform where the farmers can go to buy. Now, they started this a couple of years ago, and so it launched in 2019, but it was kind of a soft launch at the time, and it was performing well, but then the pandemic hit, and the farmers did what everyone else did, and they all started ordering online. So instead of having kind of a slow adoption of this technology, all the farmers dove in. So in 2020, the revenue from that segment more than doubled from the company's estimate, which was only supposed to be about 500 million because it was newly launched. They thought it would do better than 2019 when they did the soft launch, but they were shocked to find it was 1.2 billion instead of the 500 million. And that was 4 times the 2019 level. And that momentum has carried into 2021 now, because once you start buying your seeds and everything else online, fertilizers, all that stuff, why change now? You're not going to. So they're being very innovative in adopting technology for the farming industry to, increase productivity and all these things. So I like them a lot. And then they have the fertilizer side, which is entering into this strong upcycle as well. And they're yielding 3.3% right now, even though the shares, so it's pretty good.
Yeah.
And, even though the shares are up about 47% in the last year, but they still got that big yield. So, and they are dedicated to the yield, partially because things have been not good the last couple of years on the fertilizer side. And so this is one of those companies that to keep the shareholders happy and sticking around, they did have to pay out the decent dividend to keep everybody, on board. But now they have both the combination of the good dividend plus the good business underlying it. So right. I'm liking this upcycle here in farming. And so if you want to play that some way without buying one of the equipment makers or that kind of thing, then Nutrien NTR is a good way, I feel, to get this exposure with some innovation.
Absolutely. So I wanted to kind of talk over how dividends can be beneficial in times of volatility really quickly.
Yeah.
Because I think that's an important way to take advantage of them. So the past few weeks have been, we've seen lots of up and downs of the market, lots of up and downs in our portfolios. And with dividends, investors can get some relief during these times. So you can either pocket that extra cash, right? So save it for a rainy day, put it in an emergency fund, whatever you want to do.
Mm-hmm.
But you can also reinvest those dividend dollars, those dividend payouts. And that's what makes dividends really awesome. So you can purchase additional shares, right, with the money that you receive, and that will help you grow your investments quickly and quietly. And then, when you hit retirement age, when you hit 65, 70, 72, whenever you decide to retire, you are already creating extra revenue streams in your nest egg years. And that's really important. Yeah. And that's what makes dividends just a really cool way to, build your portfolio that isn't buying 10,000 shares of GameStop.
Right.
Yeah.
And if you allow the dividends to compound for a number of years, you might be surprised at how much it adds to your position in that stock and your overall portfolio. Because I didn't think much about it, but I've owned a couple of dividend payers for 5 or 6 years. And now that I've owned them for a number of years, I'm shocked at how much dividend I'm getting. And these are stocks that are yielding 2.5%. So they're not even the 5%ers or anything like that.
Yeah.
But 2.5% is still pretty decent. And if you own it over the course of a number of years, again, it starts to compound. And now I'm getting more shares every year because it's just is adding on because I'm reinvesting it. And it's been a nice little surprise at how well it's compounded even over the course of 5 years. So I can't imagine what it would be like, to do 20 or 30 years compounding those dividends. Now that's when you get real power.
Right. And I feel like that goes to what you were asking earlier, why younger investors are starting to like dividends. And I think it's because, millennials, Gen Z, even the tail end of your generation, the Gen Xers, we're seeing, for a while, there was, these headlines where the Social Security is going to run out by the time certain individuals reach retirement. Right. So millennials will never be able to afford a house because they are buying too much avocado toast or some silly thing like that. So I just feel like for my generation, I am a millennial coming out of the Great Recession, and seeing how that just decimated my grandparents' retirement savings, for instance. And I think the lure of dividends is just building a solid foundation for when I do reach those pivotal years in my late 60s, early 70s, when I am really starting to think about retirement, and when the money and the other things that allowed previous generations to feel really secure maybe won't be there anymore.
Yeah.
So dividends just allow to create it's like a safety net, essentially.
Yeah. And it can go to a lot of your performance. Again, if you're getting 3%, then, you only need 7% in the stock to get the 10% a year, which is, pretty good return. I know it doesn't sound that great right now from some people, what, 10%? No. But I just Kathy Wood on a TV interview, and she said she aims to get 15% a year with any new addition to any of her ETFs, and that would double the value of that stock within 5 years if you get the 15%, which is very high. But imagine it's a little bit easier maybe to get to some of those levels if you're already getting 2.5% or 5% just from the dividend and you're reinvesting it in. So it does go a long way. There was one finance book that I read that talked about this and said why some of the older dividend payers outperformed the kind of sleek and new non-dividend payers over the course of several decades. And it was literally because you got like 2 or 3% more in that dividend and you compounded it. And so it made the difference. Yeah. Although then I looked and I recently saw the list of the 30 best performing S&P stocks over the last 30 years. And I do have to say that several of the top ones on that list do not pay dividends, which is unique. I mean, that's amazing. Yeah. They were able to compound at over 30% annualized during that time period without paying the dividend. But we're not all so lucky to pick those winners. So we're going to need a little bit of help. And I feel the dividends gives you that little bit of help in there. Yeah. And I mean, think about what even just the Apple dividend does to Berkshire Hathaway's portfolio.
Right.
He basically is getting so much cash even just from, and the yield isn't even that good, right? You said like
it's 0.7% right now.
So that's nothing that great, right?
Yeah.
And he has a big position and it's creating so much cash and whatnot. He's he loves it. And so you can really see, and he's owned 5 years now. So it was yielding higher when he first originally bought in.
Yeah.
But yeah, you can really see what happens. Now, one other thing I did want to talk about, there are some other tech stocks other than like Microsoft, Apple, or IBM that we just were mentioning. There are some semiconductors that pay decent dividend yields that people should maybe go and check out as well. One of my favorites is Broadcom, AVGO. Is the ticker because it's yielding 3.4%. And those shares have pulled back in this growth stock sell-off we've had here in 2021, at least a little bit. So you might be able to get it in there a little bit cheaper, but that's a nice dividend, 3.4%. Also, some retailers also pay the dividend, and some of those might not be as innovative, but you might find a retailer here or there that does have innovation in it. And so be looking for that. One of them might be a company like Herman Miller, MLHR is the ticker.
Yes.
So they own Design Within Reach, which is a trendy home furnishings company, but they also make office furniture. And a lot of what they make is considered kind of cutting edge and innovative. And they also started an alliance making video gaming chairs for video gamers. So
wow, okay.
That are all have the tech like installed in the chair. And that's a big deal. So that's very innovative. So don't rule out some of these retailers. They did stop the dividend initially during the coronavirus pandemic crisis, but they reinstated it and it's yielding 1.9% currently. So that is above the S&P 500. But they haven't reported earnings yet. We'll see how they do. And they could be a pandemic reopen play because they do make the office furniture, which has really lagged, obviously, in the last year. So we'll see what's going on with that. But I feel like there are, you got to kind of dig around to find the innovators. But there are some out there. They're not all AT&T.
Which has like over 7. It's like yielding over 7% right now. So
AT&T is over 7.
AT&T is over 7. Verizon is not that high. When I sold it from income, it was 4 something. It was under 5, but it's still really good. But yeah, like you don't have to buy AT&T. You don't have to buy a utility like Dominion. You can. Their tech stocks can be dividend stocks, and I think that's something that we need to like keep drilling into people that you can. Buy into any tech sector that you want and probably be able to find a dividend stock.
Yeah. Okay. Well, this has been interesting and I hope helpful to a lot of people who want to get the cash, because as we see, you and I own several of these in our own portfolios because we like to get the cash too.
Yes.
It's fun. I like seeing that little dividend go in there, even if it's not very much. You'd be surprised. Occasionally I have gotten like $1 or $2 dividend like quarterly dividends in some of my holdings. It does make me laugh, but they pay it out anyways, equal the same. And it does add up over time. Okay, let me recap some of the tickers we've talked about. So we did talk about Microsoft, ticker MSFT. I do own that one in my personal portfolio. I kind of didn't buy it for the dividend, though, but it is nice to get it. IBM is paying over 5%, but we kind of know what some of their problems are, but they're paying you to stick around. IBM is the ticker. We talked a little bit about the big oils because they're paying that big dividend right now. Chevron is CVX, and Maddie did just recently add it to the income investor. I think I called it dividend investor in the beginning. It's income investor is the Zach's newsletter that he edits and runs. But you all would know what I'm talking about. So yes, that's Chevron CVX, and Exxon is its partner, XOM. They also pay the big yield. Then we talked about ABBV, which I just bought because I do like its story. And that is ABBV, almost paying 5%. It's 4.9 right now. Then Innovative Industrial Properties is the cannabis stock, IIPR, with a little bit of danger in there, but it's yielding 3%, and it's a REIT. Then we had Weyerhaeuser, that's a REIT, ticker WY, on the timber side, yielding about 2%. Then we had Nutrien, which is in farming out of Canada, and that one is yielding, let me check my paper, 3.3%. So not a bad yield there with NTR is the ticker. And then we mentioned a few more at the end here. Apple, we all know that one, AAPL, but it's under 1%. Herman Miller's out there, MLHR, and that's about 1.9%. And I think that was about it. No, Broadcom. I almost forgot Broadcom. AVGO, AVGO, or did I say that one? 3.4% is the yield on that one. That's a lot of stock ideas, but you need to go and check them out, research them, go on Zacks.com, check out the ranks, see what the earnings are looking like, and get some of your free cash, or it's not totally free, but get your cash as a shareholder. And as always, I will be back next week with some more stocks. So be sure to subscribe. Get us on Apple Podcasts. We're on Spotify. We're on Amazon Music now. We're everywhere, but get us somewhere. And I'll see you again next week.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.